So we've traditionally, had all of our usage in DeFi coming from crypto native assets, right? So I think currently we have just under 9 billion in TVL, and I think that's really cool. But I think tokenized assets are going to outscale crypto native by order of magnitude within the next 24 months. And I think a personal goal for us right now is how quickly can we have that flip happen in Chronicle, where we secure more in tokenized assets than we secure crypto native assets.
All right, here we are with Nicholas Kunkel, the founder of Chronicle Labs, an Oracle provider for crypto and DeFi. Nick, it's so great to have you on the Defiant Podcast finally.
It's my pleasure. I'm so excited to be here.
Yay. And what a setting in Cannes for ETC. So really great to do this interview here.
Couldn't paint a prettier picture.
Right.
Yeah, reality is stranger than fiction.
Yes, for sure. Okay, so I'd love to start with the backstory of yourself and Chronicle Labs. So you're OG in crypto. You started out at Maker, built the first Oracle for the original DeFi protocol. So can you, what kind of led you there, and why start your own Oracle company?
Absolutely. I think MakerDAO was very early to having this vision of a DeFi ecosystem that we thought might one day exist, and we thought a stablecoin would be very important for that ecosystem, and that's what we set out to build. And in going through that journey, it was like, oh well, we're missing oracles, and we need some, and they don't exist, right? So we had to build myself and Mariano Conti. We built the first oracles on Ethereum. But there were many other examples of this, like DEXs did not exist. And so MakerDAO built the first decentralized exchange on Ethereum.
I didn't realize that. Before
because
Uniswap and Banker?
Way before Ether Delta even.
No,
it was the first,
I did not know that.
It was first called Simple Market, then it was called MKR Market, and what later became renamed to Oasis.
Oh, okay, I remember Oasis for sure. Okay.
Yeah.
Wow, I didn't know that. And why did you, so this is like a sidetrack, but like why did you need the DEX inside of MakerDAO?
Well, because ICOs were not a thing yet, and we needed funding. And so how were we going to sell our token if it wasn't listed on a centralized exchange? So over a weekend, a gentleman by the name of Daniel Brockman, he just whipped it together, like in one weekend. He said, and, that's, I don't think he realized at the time, right? He created like a new primitive for DeFi.
It was a custom-made DEX to sell Maker against ETH?
It was, it could support any ERC20 tokens, and it was very primitive. So there was no order matching. So you could either create a buy order or create a sell order, but someone else would have to click on that order to fill it.
Oh, I see, okay.
Right, so if there was someone buying 5 MKR and another one buying 4 MKR, if you were selling 8, you couldn't fill both of those at the same time. You had to fill 5 of the first one and 3 of the second. It was
like a marketplace.
It's very basic, but it was like it was still a peer-to-peer, completely decentralized marketplace. And
so at the time, this is an example of how early Maker was and you guys were in DeFi. You had to create your own primitives to make things work, and so that's what happened when you were building an Oracle. Can you go through the process of what was the pain point that you were feeling with that?
So one of the problems that we saw was that oracles were incredibly gas inefficient. And you might remember in the early years of Ethereum, gas price was a very big problem.
Yeah.
Right. We had 500 gwei, 1,000 gwei. I think during Black Thursday we saw 7,000 gwei. Right. And this meant that running oracles was incredibly expensive. I believe in 2021, MakerDAO spent $6 million on gas alone for operating oracles. And so fortunately, MakerDAO was generating a lot of money and could afford this, right? But this helped me identify this problem that oracles had, and was kind of the impetus for spinning out Chronicle and really redesigning an oracle from the ground up for efficiency. And that's kind of what we did. I think we can do an oracle update now in 52,000 gas. And just for context, right? Like the default Ethereum transaction cost is 21,000, right? So we've really cut it to the limit, right? And that was kind of the first iteration and kind of why we thought that this would be interesting as a product, right, to the bigger market and not just to MakerDAO and its ecosystem.
And so what are some of the differences between Chronicle Labs and some of the other big oracle providers, Chainlink, Bith also now kind of up and coming?
Absolutely. So I think there's clearly some differences in technology, but also I think in terms of strategic focus.
Okay.
So starting on the technology side, what we do is use a signature scheme called Schnorr signatures. And the only thing that's kind of important about them is that you can have this many-to-one relationship of signers to signatures. So you can have many validators collaborate to generate a single signature. And this is in contrast to what most oracles use, which is a ECDSA signature, which is one-to-one, right? Okay. One signer, one signature. And what this really enables us to do is have a near unlimited amount of validators that can kind of contribute to consensus. And that's really a kind of factor of, right, how secure are you, right? How distributed and broad is your validator set, without kind of having this gas inefficiency penalty of having to verify 100 signatures, 200 signatures. So I think that's on the technology side, that's like the core scalability improvement we've made. And so we have many more validators than most, and so we have some really interesting kind of DeFi kind of flagship projects that, or not even DeFi but crypto, that run our validators like Gitcoin, Infura, MakerDAO of course, but even some institutional exposure like Bitcoin Suisse, for instance, who joined relatively recently. And there's many others.
So what's the benefit for end users to having multiple signatures?
It is essentially a stronger security guarantee, right? That the oracle cannot be manipulated, right? The more broader of a validator set you have, right, the harder and harder it is for those validators to collude in an attempt to manipulate the oracle.
And what is the trade-off in doing that? Like, does it slow things down, for example, or?
Interesting you should say that, right? There are some trade-offs because a Schnorr signature, right, we said it's signed by many different validators. They have to sign in sequence, right? So validator number 1, 2, 3, 4, right, one after the other. Versus with ECDSA signatures, this can be done in parallel, right? Because every validator is generating their own. So from a latency point of view, it is slightly slower. Fortunately, though, I think given the fastest block times that we see right now, which is mega ETH at around 100 milliseconds, we can still generate Oracle updates significantly faster than that.
Okay.
It is a trade-off, you're right, but it's currently not a bottleneck. And so we'll see how, if anyone else comes along, that claims to have even faster block times than mega ETH at 100 milliseconds.
Okay. That's interesting. Okay, and then you said one aspect was technical and then the other was strategic.
Sure. So I think we made a bet very early on tokenized assets. I think tokenized assets are really the next stage of DeFi and kind of a critical stepping stone to this merging of traditional finance and decentralized finance, and one day we will just call it finance, right? And we really started on this journey earlier than most, probably because Maker was the earliest adopter of tokenized assets. Maker had a really big problem where in the bull market, everybody wants leverage. And that means that Maker was making a lot of money, $300, $400 million revenue annually. But then in the bear market, nobody wants leverage. And so, you would be making 50, 60 million a year. And that kind of volatility in your revenue is not really great for sustainably running a business and a team and investing in new products. And so there was a real impetus to start allocating and getting exposure to the traditional financial system in order to smooth out that revenue. And so, some of the earliest RWA projects were like Centrifuge, right? Who, even though now are starting to become a really big player, right? In 2017, there was very little demand for this stuff, but Maker and Centrifuge had been working together since that time, and so I've really had like a first-hand exposure to what are the problems that a DeFi protocol was having trying to integrate a tokenized asset when it didn't quite fit the mold of the native crypto assets that we were onboarding, and what kind of infrastructure was required, and what kind of data was required, and what were these extra risks that we somehow needed to come up with technical solutions for. And so I think that gave us a better understanding than most of how oracles would change, how their role would change from where in DeFi it's traditionally a price, right? A price to make sure the loan to values are reasonable, a price to trigger liquidations, and now really encapsulating more of a broader data spectrum to allow those DeFi protocols to manage their risk exposure to these tokenized assets in a smarter and more automated way that mimics the ability that they have with crypto native assets.
So what other type of data do you have to specialize in to really enable RWAs?
Absolutely. So I think one of the most popular tokenized assets over the past 12 months has been these tokenized money market funds or tokenized treasury bills. This doesn't come as a surprise, right? Because the yields are very attractive and the risk is very low, and the issuers, right, like BlackRock, securitized BUIDL, right, like Superstate, like Centrifuge, right, are fairly credible. So I think there was like a magical kind of soup there. But to your question, right? What kind of data is interesting? Let's use the tokenized money market funds as an example. Each of these is composed of a portfolio of different short-dated treasuries, right? And so, even though the performance of the whole might be, okay, it's the total portfolio is worth this much and it's generating this much yield, you can have maturity distribution mismatches. So what I mean by this is a treasury bill, right? It has a term, and after that term, it matures, right? And so then the fund will need to go and reinvest that money into newer issued treasury bills. When you're investing at scale, like Maker at Sky is, in the billions, liquidity becomes a huge concern, right? If that position needs to be unwound, can you unwind $1 billion, or can you unwind $1 billion over 2 days or over 3 days? And so the protocol needs to have the context of, well, how much is maturing this month? How much is maturing the next month? How much is maturing the following month? What type of liquidity is there to sell these treasuries before maturity without having a significant market impact, right? Where you would start taking on a certain amount of losses, right, so to speak. So these questions become really important when you're operating on the scale of billions here. Now, treasuries, I think, are an interesting example because they're the most liquid market in the world. I think where the whole problem kind of levels up is private credit. And private credit is really where I believe we will see the most growth.
Well, it's the biggest market right now within RWAs already.
Absolutely. And it's also one of the hardest to deal with.
I imagine a lot more opaque, less liquid, obviously.
If you, for T-bills, right, there are hundreds of millions of people out there who are a potential buyer of your T-bill. For private credit, there's maybe half a dozen, right? And so it is more difficult to model this already in a TradFi kind of context, and then tokenizing this and kind of adds an extra layer of complexity there, right? You may have on-chain liquidity and off-chain liquidity, and how do you reconcile those two? And is any one more important? And so it's a very interesting problem, but it's one that as an Oracle provider, we're like tackling now, and it's more fun than I've had in years, because it's a really interesting problem that's not the cookie cutter DeFi formula of okay, here's a token, let's get some price sources, here's the price, right? Okay, send it to the customer, right? This is like
a lot more sophisticated.
A lot more sophisticated and creative, and there's new challenges and problems, and it's so fun.
It's interesting. Like I hadn't thought of kind of RWAs in that way. In the fact that RWAs have been such a big trend in DeFi, and yeah, like everyone is all for bringing all assets on chain, and yeah, like you have T-bills and private credit, and then people want to bring in everything from like real estate and art, and but yeah, like when people say those things, I don't think anyone is like, the first thing that comes to mind isn't okay, like, but how do we get the data that's needed for this to work on chain? So yeah, like it's an interesting challenge. with all of these new markets coming on board. How do you foresee that evolving? So T-bills on private credit are like the big RWA focus right now. What are you prepared for, like other markets to come on chain, or like or are you just like focusing on these two to start?
So clearly, private credit and treasuries are the biggest in market size right now. So of course we are very active in those domains. But just yesterday we saw Robinhood announce, right, that they're going to be tokenizing equities, and especially tokenizing non-public equities, right, like SpaceX, for instance, which is a unique value proposition. So I think that's very interesting. I think in the commodities side of things, we had so far it's been mostly gold, right? We had Tether, I believe last year or earlier this year, right, launch a gold-backed kind of tokenized asset. So I think that's incredibly interesting as well. But yes, I do see the primary drivers of growth, right, continuing to be private credit, with treasuries increasing in size, but at a slower rate than what we've seen, due to the expectation of monetary policy becoming a bit looser in the coming months, 6 to 12 months.
Okay, makes sense. But the next kind of lower hanging fruits, you think will be equities and commodities?
Yeah, absolutely.
In RWAs. Can you maybe take a step back and describe why oracles are a different challenge for on-chain markets versus off-chain? Like how do off-chain markets handle their data, and how is that different from how that's handled in DeFi and crypto?
So I think there's starting to be a convergence, right? I think we, in DeFi, we have quite a few people who have no traditional financial experience, and yet we've independently come up with some of the same solutions as we've quote unquote speed run traditional finance in just a few short years. Right, the corollary to oracles in the traditional financial world are the data brokers, right? It's the Bloombergs and Reuters of the world, and it is almost like a regulatory requirement, right? That you're getting data, right? That from a risk management point of view, that you're not just getting data from one source or from one broker, that you have fallback data that you rely on as well. And I think DeFi is kind of going through this same maturity cycle at the moment, where it started off that oracles were just getting data from on-chain and from centralized exchanges, and now, right, we are starting to tap into those traditional markets as data sources, just as I imagine and expect Bloomberg and Reuters are looking to tap into the on-chain data sources to start offering that to their clients. And I think what will end up happening is this convergence, right, where Bloomberg and Reuters will eventually offer Oracle services as well, is my guess. And the Oracle providers, like ourselves, like Chainlink, will be directly competing with them.
Interesting. Where do you think your edge would be in that case?
Right. So I think we're burning the candle from both sides, right? We certainly have the crypto native experience, not just from Chronicle, but even from the maker days of really building DeFi from the ground up. But I think also we are much more involved on the tokenized asset side than necessarily they are at this point. And so I think that's our kind of competitive advantage, in that we can see opportunities and see what is potentially just fluff and what is going to actually be like really, really big, and make sure that we are getting those opportunities, right? And we are embedding ourselves in that kind of fabric as finance as a whole is going through this transformation. On their end, right, what benefits do they have? I mean, their network, right? They already are working with all of the data providers, like the custodians, like the asset managers, right? And so that's probably our weakness, right? Because we have to go and create those relationships, create those technical integrations, and but it's fun, right?
Yeah.
Each of us has a superpower, and we're charging in each other's direction.
Yeah. No, will be fun to watch how, you know, those two converge. Can you walk me through your business model, and whether related to that, whether there will be a token involved at some point?
So I think oracles actually have one of the more obvious business models in crypto, in that oracles are a service that are necessary, and the users of those services, right, are paying us. So it's quite monetizable in that respect. In particular, tokenized assets, I think, are one of the easiest to monetize as well, because the asset issuer is usually kind of collecting some, or fund manager is usually collecting some management fee, right? And so, you know, our business model is, you know, we can cut off a sliver of that management fee, right, for our services that enable this tokenization to be successful.
Okay. How do you determine what that fee is?
I mean, at the moment, it's kind of on a case-by-case basis, right? You know, we work with very many different parties under different circumstances, but I do expect that there's some convergence, and on the tokenized asset side, I just expect it to essentially scale with the size of the issuance, right?
Okay. And regarding a potential native token, is that something you're planning?
It's not something that we're ruling out, but it's not something that we have immediate plans for either. What's important to me is that if we were to make a token, that it makes sense. I think we have enough tokens that don't necessarily have a purpose or like a real utility, and I would not want to have Chronicle be one of those.
For sure. How can you optimize Chronicle to be the best suited for RWAs?
I think we're kind of already doing it in the sense that through our kind of partnership with the Sky ecosystem, including Sky and Growth, who are currently some of the largest capital allocators into tokenized assets. You know, we work incredibly closely with them, and so those teams are at the forefront of most of the major tokenized asset issuances in the space right now, and you know, we try to partner with all of those. And so the idea is that you know, we will be able to build up a pretty significant market share on top of what we already have, right, and kind of snowball from there. I think you know, this is not very novel, right? I think Chainlink has very effectively utilized the same strategy of converting a moat in DeFi into credibility, right, with traditional financial institutions, and we're kind of doing the same, but going through the asset issuers. instead for tokenized assets.
Makes sense. And your relationship with Maker and Sky now, and that definitely kind of cements your place in that area.
Absolutely, right? I mean, Chronicle is not a part of Sky, right? We are independent, but there are enormous synergies in what we kind of call the greater Sky ecosystem. And in essence, there's almost like a Maker mafia, right? That kind of has left Maker or stayed in that orbit and created new entities, right? And which is how you got Sky, which is how you got Spark. Steakhouse, Grove, M0. Both of the co-founders.
True, yeah.
You had some of the fixed rate protocols like Sense. So there's actually a very diverse group of ex-Maker people out there still innovating, and we've all worked together for many years, and we trust each other. So there's a lot of value there.
For sure. Now getting to what's next for you, like what are the big milestones that you're working towards?
We've traditionally, had all of our usage in DeFi coming from crypto native assets, right? So I think currently we have just under 9 billion in TVL, and I think that's really cool. But I think tokenized assets are going to outscale crypto native by order of magnitude within the next 24 months. And I think a personal goal for us right now is how quickly can we have that flip happen in Chronicle, where we secure more in tokenized assets than we secure crypto native assets. And I think we're well on our way there. Like the road is fairly clear, but now it's time to execute. And I think over the next 6, maybe 12 conservatively, but 6 optimistically, we're going to be able to get there.
To have a tokenized real world assets flip on
Exactly.
chain.
Right. So
Interesting.
10 billion DeFi, more than 10 billion tokenized asset.
That'll be an interesting metric to watch. Related to that, actually, curious about your thoughts on the kind of the big criticism for RWAs in DeFi, which is just like censorship or lack thereof of having RWAs in DeFi.
Absolutely. I mean, I think that's valid criticism. There is something to be said for keeping DeFi in a purely decentralized context. I myself am a bit more of a pragmatist. I think that in TradFi you already have a bunch of parties that don't trust each other necessarily, and they've come up with appropriate risk controls, right, to manage exposure to protect themselves. And so I think you can have, completely decentralized chains with completely decentralized, financial primitives running on top of them that incorporate tokenized assets, but keep the exposure limited or at least diversified to such an extent, right, that even a complete failure in a particular tokenized asset doesn't create any solvency issues for the financial kind of credit engine that's underlying it. And I do understand the criticism, right? Why even integrate it at all? But it's a question of scale. If DeFi is limited by what is the total market cap of BTC, ETH, and Solana summed together, we're never going to get to the scale that we need to be and have the impact on the world that we know we can have. And so it's a bit of a deal with the devil, yes. But I think if done the right way, where people aren't too greedy and blinded by adding another zero or two more zeros, right? If we're cognizant of the risk and responsible, this middle path can actually be like the optimal path.
That makes sense. Then to wrap up, I'd love your long-term big vision for Chronicle. Like, what would you want Chronicle Labs to look like in 10 years, or name your timeline?
My vision is that decentralized finance and traditional finance merge together, and we don't even differentiate them anymore. It will just be called finance. And my vision for Chronicle is that Chronicle is just embedded in that financial fabric of the world. So it's not necessarily that when you do a bank payment that you see like all the stuff that goes on underneath, right? Like you couldn't imagine that you're actually still using a mainframe from the 1970s, right? Written in COBOL, but you are. And I believe that decentralized rails are going to replace all of that, and I think Chronicle is going to be kind of critical and essential infrastructure powering those rails.
Awesome. That's a big, ambitious vision. So very, very happy to have heard it from you here on our podcast. So thanks so much for joining.
Yeah, thank you so much for having me. This has been great.